Basically, this is a presentation that's trying to present some of the ideas behind value chains and behind impact investing, thinking that perhaps not everyone who's here is very conversant on these topics. And actually, it comes back wherever Andy is. Andy, thank you for teeing up that bit in the middle between the science that comes down and that's where value chains sit. I think that basically sums up what we're going to be talking about. So I mean, it's one of the areas where this actually, I think, has quite a bit of relevance for what we're going to be talking about here in CCAFS. So what I wanted to go through with you all today is a very brief overview of value chains, what we understand them to be, a little subset of value chains, which is business models, and then talk about impact investing. And this is very much an opening presentation. It will be complemented by presentations by John and by Pete later on this afternoon. So basically, the first question is, why do we care about this? What do value chains, or what does value chains and resilience, what does this have to do with development? What does this have to do with climate change, and why is it of interest? I think the first point here that's important to bear in mind is that this is of interest because of the role of smallholders. Smallholders are increasingly seen at the center, not only of food production, but also of many longer value chains throughout the world, and the important role that they're playing in food security and environmental stewardship. The second piece here is that people tend to feel that climate resilient, and again, building on the previous presentation, I'm not going to go into what we mean in a lot of detail on that, but basically chains that can adapt and basically survive shocks, can have potential benefits both for producers as well as for consumers. And this comes back to the issue of the food price shocks that were mentioned earlier, and it comes back to the issue of livelihood resilience at the farm level. People feel there's an emerging consensus both from the public sector as well as from donors as well as from private sector actors that value chains is a nice way of pulling all of this together, right? These market linkages. The third one, which I think is important here in terms of incentives, is the focus that a lot of the buyers of agricultural goods are beginning to place on how to develop systems that allow them to have continual access to raw materials. This is actually a major driver if we talk about potential uptake of climate-smart practices in value chains, because one of the worst things that can happen to a large company is to have its plants not be able to process because there's no raw materials. So this actually is a very, very strong leverage point to drive uptake. And then finally, there's a emerging sense here that the development of market-based incentives or market-based structures that allow us to incorporate and leverage climate-smart practices is a potentially more sustainable way of going about it, and complements more public sector sort of regulatory approaches. So that's sort of the general background of what we're going to be talking about today. So, it's pretty clear where we want to go, but we don't really know how to get there. And this is the point that I think we need to be very clear about among ourselves. We have an awful lot of science, we have an awful lot of experience, and as we heard from Andy, our estimates or our guesstimates or our projections are getting better. Yeah, we have a better idea of what's going to happen, we have a better idea when it's going to happen. But this doesn't necessarily mean that others know how to act on it. So the challenge for us, I think, as CCAFS, and if you'll let me use your hat and pretend to be CCAFS for a bit, is precisely how do we engage and how do we have that conversation that becomes in a way that it becomes actionable. Okay, how do we go beyond just providing, and I'll look at Peter on this comment, how do we go beyond just providing really scary maps where people go, oh my God, life is ending, to actually something where people can act and actually do things in a really, really feasible way. So I think this comes back to a very simple idea. It's about carrots and it's about sticks, and it's finally about the incentives. How do we get the incentives right? How can we begin to move into incentives to actually act, as opposed to just scare people, or as opposed to just raise issues, or opposed to just communicate? And so I think that's the challenge. And what I would say to you is that one of the potential ways to get these incentives aligned and to get things actually moving is to use an approach like value chains, or to use an approach like a business model, or to partner with people like impact investing. So that's what I'm going to talk about a little bit for the rest of my time here. So if we go to the value chain quickly, again, we've been talking about systems. We talked about systems dynamics and system sustainability. A value chain really is just a type of a system. So what we're talking about here is understanding how, within this relatively complex system where you've got the direct sort of farmer to consumer chain, you've got a range of support services, and you've got sort of the external forces that act on a value chain, how can we begin to identify where climate science, where climate smart agricultural practices, where other kinds of public incentives, whether that be regulation, whether those be NAMAs or NAPAs or LEDs or whatever we're talking about, or where private incentives fit. And how can we align these things in such a way that it actually begins not just to push sustainability from the production end out, but actually pull. And so that is the utility of using a value chain focus here, is finding ways that we can actually align interests in such a way that we're pulling, we're providing incentives to implement, we're providing ways to not just provide technology, but to make it profitable to implement technologies that are more sustainable. That's the big piece. If we look at, another way to look at it is looking at the business models, and this is one that we use a lot in CRP2 and in other CRPs. The idea here is how can you deconstruct the value chain, because at this level we're talking about a system, it's fairly complex to understand, but at this level you can bring it down to a specific company. How can you understand what a specific buyer or type of buyer, whether that be a formal exporter, whether that be an informal buyer in a wholesale market, how can we understand how their business model does or does not provide those incentives back along the chain? And so this is another piece of the framework that I think we can make use of. And essentially what we're talking about here is, again, identifying what it is that we can do, where can we intervene so that these incentives align and pull. So here's a description of the business model. We don't need to go into it, but it's principally how a business makes money. And these business models can be, the chain can be looked at as a system, or it can be looked at as a linked set of business models. So these are just frameworks. What I want to leave you with here is this question, is how do we use these kind of frameworks to align incentives and resilience for resilience among the actors? And I think this is a big question. When we've done this kind of work in a very concrete way, for example, coffee in Central America, yeah, the conversations are very interesting. People are very interested in how to promote resilience among small coffee producers in Central America. Yeah, we go through and we can do, and we can assess with the help of Peter and other people from the CCAFS team how exposed different coffee systems are to climate change. We can begin to say, well, here we need to have, Sonia's three circles are very useful. Here we really don't need all that much adaptation. Here we need a moderate level of adaptation, and here you've got some serious problems. And you can begin to identify what needs to happen. The hard part here is actually A, costing it out, and B, finding out how we can do it in such a way that those costs do not fall disproportionately on the weaker or the poorer members of the chain. And those conversations, I think, the upside is there is interest and there is appetite on the part of the private sector to have that conversation. The downside is it's still not entirely clear that it's a good business proposition to make those investments. I mean, Peter can provide a lot more information on the experiences we've had in Central America on that, but I think it's a great example of where we've shown that it's feasible to do, but yet the uptake from the private sector is still not there. So I would think in livestock there have been similar experiences in East Africa as well. So I think these are the kind of things that we need to think about. My point for CCAFS, and something that we'll be discussing later on in the session with two brilliant presentations that will complement what I'm saying here, is basically, how can these frameworks be made useful for CCAFS? How can they fit in? How can they be part of your impact pathway? Yeah? How can we think about this as ways to scale? How can we think about this as ways to go beyond just sort of pilot interventions? So I'm going to stop there on this because I think probably people are more familiar with value chains than they are with the other piece that I've been asked to talk about, which is impact investing. Just a quick comment to Andy here. I wasn't supposed to do this presentation originally, so you'll have to excuse me for the impact investing piece because I'm not an expert on this. Basically, what we're talking about here and why I'm raising the issues, I think it's a very interesting emerging area of finance. Finance is something that we often talk about in the area of adaptation and mitigation, but particularly in adaptation. And the question always comes up: how do you fund this? Who pays for adaptation? So the reason that impact investing is interesting here is because potentially this is a space to begin to access capital and access money to actually fund some of the adaptation practices that we're identifying. There's a brief definition here of what impact investing is. This is a very generic one from the Global Impact Investing Network. And there are three pillars here that are important. One is the intentionality behind impact investing. The intentionality of impact investing is to go beyond just a financial return, but to actually have a social or an environmental return. So it's sort of a wider public good, if you will, from the investment. Second, there are return expectations. None of these, different from a grant, an impact investment does expect to receive a return on investment, normally at a minimum to cover the capital that's been invested. And the third one, which I think is important and potentially of great use to us, is that there is a common and consistent focus on measuring actually what this means. So there is an impact assessment or a measurement function, which I think from a research perspective is actually really interesting because it allows us to identify and track what these investments really mean over time. So there's a very nice document I'm happy to share with all of you. But basically the important messages of this document, and we're going to look at a few more pieces of it, is that there's been an advance over the last few years of a social impact investment model that's proven to be quite successful. However, this model, which focuses on smallholder organizations, has some limitations, and it's interesting to think about what those limitations mean for us. The major limitation here is that it's based on farmer organizations, and if we talk about farmer organizations, in many of the countries we work in, we're talking about maybe 10% of the farm population. The lucky 10%, I always say. These are the ones who are able to get organized. They were the ones who were able to access donor money, had access or had connections to the market, and therefore these are the 10% that impact investing tends to be able to reach. The interesting part about all of this is the final piece here. The demand that's emerging now is to expand the model, and find novel ways to work. And one of the areas that's emerging as a clear demand is, there are two that actually are of interest to us here. One is, how do you begin to apply this kind of a model to local food crops? So I think that's a potentially very interesting space for us to be in. And secondly, the issue of climate change. These are impact investors that they're usually taking a time horizon of anywhere from 5 to 10 to 15 years. Some of these projects are focused on renovating agroforestry or tree crops. And so the issue of climate change and understanding where climate change is going to happen, what its effects might be, what kind of practices to promote becomes very, very relevant for these kind of actors. So potentially, this is an interesting partner to explore. So let's go into this in a little bit more detail. So this is the big number. Okay, that's the estimated gap of impact or of financing needed by smallholders globally. It's 450 billion. Here we have the possible gap that could be covered by impact investing. So it's $22 billion. It's a minor figure, right? It's pretty big. And so the point here is that there is a potential that's very, very large as a scaling point for work with CCAFS. Secondly, you can't really see it, but this is the actual lending landscape as we have in terms of crops and regions. Principally focused, as you can see, historically on coffee and cocoa, but rapidly expanding into other crops, as I mentioned, rapidly expanding into basic grains, rapidly expanding into rice, maize, sorghum, and we'll show an example of maize in a second. And these are the kind of crops where I think, again, there might well be common cause between CCAFS, between the wider CG and some of these impact investors. Here's an idea of who's involved. This is from 2011. We're talking about $354 million invested in 2011 through impact investing. So again, an interesting vehicle potentially to leverage some of this money for work on climate change adaptation. Some of the crops that have been identified as potential for work globally. You'll notice that several of the crops that we're interested in the CG are included, as well as some commercial crops. So I think it's an interesting balance. But you'll notice that there is a nice overlap between the areas where impact investing can be relevant, the crops where it can be relevant, and the geographies where CCAFS and the wider CG is active. And this is the other one I wanted to mention briefly. This is the graphic that I think is important. Principally, the impact investment has focused here, which is on the export crops, where you have contracts and you have formal markets. But as I said, this only accounts for about 10% of the farmer population. What's of interest here is these two, this one particularly, is how can we begin to work to finance what they call here alternative aggregation points for more of the local crops. And the question then becomes, how can CCAFS engage at that kind of a level? How can public policy engage at that level? And how can we begin to build hybrid models that allow social investors or others to make reasonable investments in farmer associations for these crops, for local markets, for local food security in ways that promote resilience? So I think this is an area that's potentially of quite a bit of interest. And these are sort of the big, these two, particularly 5, is the big, or 4, excuse me, is the big growth area going forward for impact investors. Just a couple quick examples. There's an impact snapshot from one of the industry leaders, which is Root Capital. You can't read it, so I'll let you go look at the infographic in the presentation. But basically what they're talking about here is increasing food security through loans to basically a seed provider in Kenya, to increase the availability of improved maize varieties, which lead to yield increases and lead to 8 times the number of farmers getting access to seed and yield increases. So this is an example of something where you could potentially talk about partnering with these kind of organizations to identify the technologies that are needed. They can provide the capital, they can roll out the model in a business way, in a way that makes sense, the way that makes financial sense, actually makes money and is profitable over time, and therefore you have a much more replicable and potentially sustainable model going forward. Another one here actually even has a term resilience in the title. So this is another one that's in Central America, public-private partnership focused on coffee in this case. But here you're talking about, again, a network of partners working specifically on looking how they can come together to adapt to climate risk in a specific chain. This is happening in coffee, but it's definitely underway, the replication in other chains in the region. So a couple things. Why is this interesting? Well, obviously there's a potential, as we mentioned, for this being a vehicle for promoting climate-smart agricultural practices that are of interest to CCAFS. There's a clear interest and demand for new financial products that incorporate climate resilience. I've mentioned here impact investing, but I think the other thing that's important to highlight is the increasing focus of the private sector in general on sustainable sourcing. So the impact investing is a piece of that, a very small piece of it, but in general, if you start to look across the large buyers of agricultural commodities, there's an increasing focus on the idea of how do you have sustainable supply chains. I didn't include the graphic on this because it was basically the largest numbers are in crops that aren't perhaps of much interest to us, like palm oil and others. But you're talking about significant demand, significant commitments over a time horizon to about 2020 to 2025 to have large percentage of these crops sourced in a way that is sustainable. And sustainable includes resilient, and it includes the concept, sometimes with certification, sometimes without, but it includes the idea of building in this forward-thinking process of climate smart. The problem is they don't necessarily know how to do it. Okay? We here in CCAFS have a lot of the science. There's a lot of demand on the other side. The question for me is how do we actually bring these two together? That's the big challenge. I think, again, coming back to the nice graph in the middle, your missing middle piece, that's precisely the bit. I think using a value chain or an impact investing framework is a useful way of going about it, principally because we're seeing this process of diversification. People are moving from their normal focus, or what's been the traditional focus in both value chains and in impact investing from export or formal sector crops to focusing much more on nationally relevant food security crops. So we're at a really good place in time. We need to have the conversation. The question is, where do we have it? How do we have it? With whom do we have the conversation? The important thing here as well, and this is a big challenge when we talk about the nationally relevant food security crops, is how do we have the conversation when we start to talk about informal markets, and how do we deal with informal institutions? This is a huge issue. Again, I think perhaps the Achilles heel of both the value chain approach and the impact investment approach is precisely this issue of how do you deal with the informal side. I would suspect that for public policy, again, it's a huge Achilles heel. We can talk about public policy and we can write great policy papers and write great NAMAs and whatnot, but when we're talking about systems where 80 or 90% of the agricultural production and marketing is in the informal sector, how relevant is that? So I think we really need to get our heads around how useful are the approaches we have, the tools we have, to deal with this informal piece, and how can we understand better what can be done. You know, I think the incentives question is very relevant for the informal piece, but we don't understand what those incentives are. Yeah? It's relatively more straightforward when we talk about the formal piece because we've had experience. But we don't understand in the informal side what those incentives are, and we certainly don't understand how to activate them. So I think this is a question that we need to begin to discuss in a range, again, a range of CRPs, not just CCAFs, but this is an area that we need to be working a lot more on. And the other final bit here on specifically on the impact investing, which I think is interesting for the impact pathway, if you will, of CCAFs, is the fact that these potential partners here, although they're relatively small, in the larger scheme of financing, they're actually incredibly influential. And so these are the actors who are really driving the agenda, and a lot of what happens with the impact investing community is then picked up by national level formal financial institutions, and also by multilaterals and by large international financial institutions to try things out. It's a really good space to pilot. It's a really good space to begin to say, well, how can we bring together the need for adaptation with the need for finance, with the need to have a market-based solution. So I think this is potentially a very, very interesting leverage point for CCAFS moving forward. So basically, this afternoon in the session, I'm going to make a pitch for the session now, just because some of you may not want to go. Basically, we're going to be talking about some initial questions, which I'd like to leave you with here. One, does any of what I've just said fit the CCAFS impact pathway, and if so, where? We talk a lot about impact pathways. We talk a lot about outcomes. Some of you have been in a workshop for several days talking about this, so I won't pretend to even know what you discussed. I heard the food was good and the company was good, so I assume that the work was relevant as well. But the question really is, how does any of this fit into the CCAFS impact pathway? Okay, we've got a lot of very interesting science. We've got a lot of very interesting things to share. How do we have the conversation with the relevant actors? How do we deepen our collaboration with those actors? How do we go beyond just the scary maps or the reports, and the nice pieces on the BBC and everything, to actually concrete things that we can test and we can evaluate and we can build, and we can just show how you can make this function in practice. And again, what are the limitations to these approaches? I think I mentioned the informal piece. I mentioned the focus on organizations in the case of impact investors. I mean, there are some serious limitations to some of these approaches. What can we do about it? How relevant are they, to maize producers in Africa, John? I mean, how much of the maize production could be dealt with by this, and what do we do with the large piece that's outside of it? Beans in Central America, or any of the food crops you want to talk about. And so these are the kind of questions I'd really like to discuss later on this afternoon with those of you who'd like to come and sit down and have a good discussion. So I'll stop there and hand off.